Hello and welcome to this lecture on recent changes to FRS 102. This lecture is brought to you by the team at BNO Chartered Accountants, and we hope you find the material in this session useful. Aimed at improving financial reporting practices, the latest FRS 102 amendments introduce important changes finance teams must begin preparing for today. FRS 102 is the predominant accounting standard used by small and medium businesses, SMEs, and private family businesses across the island of Ireland. It was introduced in 2013, applying to accounting periods commencing on or after the 1st of January 2015, with early adoption permitted. The UK Financial Reporting Council, FRC, is the standard setter for FRS 102 and performs periodic reviews of the accounting standard, at least every 5 years. The aim of these reviews is to take account of changes in global accounting standards such as changes to the International Accounting Standards Board, IASB, accounting standards, and to respond to specific issues as they arise, such as regulatory decisions and stakeholder feedback. Amendments are then developed and proposed after feedback has been sought from the relevant stakeholders. The first periodic review of FRS 102 was completed in December 2017, coming into effect on the 1st of January 2019, and the FRC recently completed another periodic review in March 2024. This most recent review has taken several years to complete due to the need for extensive consultations with stakeholders. The effective date of the amendments arising from this review will be applicable for accounting periods on or after the 1st of January 2026. Earlier effective dates apply to new disclosures about supplier finance arrangements, starting from the 1st of January 2025, with early application permitted. Early application is, however, permitted where all amendments are applied simultaneously. So, what are the key amendments arising from this review, and how can you prepare for these changes? One of the main amendments is in the treatment of leases. Under the current model, lessees classify leases as either finance or operating, depending on whether the lease transfers substantially all the risks and rewards of ownership from the lessor to the lessee. This approach is similar to the model used under Old Irish Generally Accepted Accounting Principles and IAS 17, leases. The FRS 102 amendments will largely align Section 20 with IFRS 16, leases, eliminating the distinction between finance and operating leases for lessees. This will require lessees to recognize right-of-use assets, ROU, and lease liabilities on the Statement of Financial Position for all leases, apart from short-term leases and low-value assets. Subsequently, the ROU is depreciated over the lease term on a straight-line basis, while the lease liabilities are amortized using the effective interest method, which results in a front-loading of the lease expense, reflecting the underlying financing nature of leases. Let's illustrate this with an example. Let's assume a lease term on a particular asset of 3 years. The annual payment payable at the end of the year is €50,000. The annual discount rate is 5%. The ROU or lease liability equates to €136,000, which is the present value of €50,000 multiplied by 3 years at a 5% discount factor. Let's go through the accounting treatments in both the Statement of Comprehensive Income and the Statement of Financial Position. In most cases, the ROU and lease liability will be equal to each other on the inception of the lease. This slide indicates the proper accounting treatments in Year 1. The amendments provide guidance on what constitutes a lease, how to determine the lease term, how to account for modifications and remeasurements, and other practical expedients. It is important not to underestimate the complexity of this new lease model. Consideration must be given to several factors, such as whether an arrangement meets the definition of a lease and how to calculate an appropriate discount rate for every lease. The 5-step revenue recognition model, Section 23, is another important amendment. This aligns Section 23 of FRS 102 with IFRS 15 revenue from contracts with customers. The 5 steps are as follows. Identify the contracts with a customer. Identify the performance obligations in the contract. Determine the transaction price. Allocate the transaction price to the performance obligations in the contract. Recognize revenue when or as the entity satisfies a performance obligation. The core principle is to align revenue recognition with the transfer of control of goods or services to customers, which may either be over time or at a point in time. This also aligns revenue recognition with the contractual terms in relation to the enforceable rights and obligations of the customer and supplier. The 5-step model aims to address the challenges in accounting for bundled goods and services by introducing the concept of allocating the consideration from the customer to the separate and distinct performance obligations representing the promised goods or services within the contract. The amendments also provide guidance on several topics, such as combining 2 or more contracts entered into, at or near the same time with the same customers, contract modifications, and some practical expedients. It is important to note that the new 5-step revenue recognition model could alter the timing of revenue recognition, especially for complex contracts with bundled goods and variable consideration. Other important amendments to note. The amendments to FRS 102 also contain several incremental improvements and clarifications, including, but not limited to, the following. IAS 39 option removal. Entities not already applying IAS 39 recognition and measurement principles for financial instruments can no longer adopt such policies under Section 11 and 12 of FRS 102. Supplier financing. Section 7 of FRS 102 will now require additional disclosures about supplier finance arrangements and their impact on SOFP and cash flows. Fair value measurement. A new Section 2A, fair value measurement, replaces the appendix to Section 2 of FRS 102, incorporating the principles of IFRS 13, fair value measurement. Going concern disclosures. Section 3 of FRS 102 has new requirements for management to affirm consideration of future information and to disclose significant judgments on going concerns. Business combinations. Section 19 of FRS 102 has been updated to include guidance on the identification of an acquirer in a business combination similar to the principles of IFRS 3 business combinations. Share-based payments. SBP. Section 26 of FRS 102 includes enhanced guidance on accounting for vesting conditions, fair value determination, and SBPs with cash alternatives. Uncertain tax treatments. Section 29 of FRS 102 includes guidance for uncertain tax treatments, which aligns with IFRIC 23 uncertainty over income tax treatments principles. Thank you for reviewing our session on recent FRS 102. We hope you found this material useful. Please like and subscribe to our channel for more future content like this.